Welcome back to the Indicator Library. Today, we're covering one of the most popular and most misunderstood tools in trading: Bollinger Bands. Most traders see three lines around price, but very few understand what they're actually showing. Bollinger Bands measure volatility. They show when the market is calm, and they show when pressure is building. In this video, we'll break down what Bollinger Bands actually represent, why price touching a band does not mean automatic reversal, what a Bollinger Squeeze really signals, how traders use bands in trending markets, how they behave in ranging markets, and a simple beginner breakout approach. Let's begin. Bollinger Bands are made up of three lines. The middle line is an average price. The top and bottom lines adjust based on how active the market is. When price starts moving aggressively, the bands spread apart. When the market becomes quiet, the bands tighten. So Bollinger Bands do not predict direction. They measure energy in the market. More movement means wider bands. Less movement means tighter bands. And that change in energy is what traders watch closely. The upper band shows when price is pushing higher than usual. The lower band shows when price is pushing lower than usual. But touching a band does not automatically mean reversal. In strong trends, price can stay near one band for a long time. This is called riding the band. So instead of reacting instantly, ask yourself what type of market you are in. Is price trending strongly? Or is it moving sideways? Understanding context is more important than reacting to a single touch. One of the most powerful signals from Bollinger Bands is the squeeze. A squeeze happens when the bands become very tight. Tight bands mean low volatility, and low volatility rarely lasts long. Markets move in cycles of quiet and expansion. When the bands compress tightly together, pressure is building. Eventually, that pressure releases. And that release can lead to strong movement. The squeeze does not tell you direction. It tells you a move is coming. There are two common ways traders use Bollinger Bands. The first is spotting when price is stretched. If price pushes strongly outside a band, it often pulls back toward the middle line. This is called mean reversion. The second method is breakout trading. After a squeeze, a strong breakout candle can signal expansion. Traders look for momentum confirmation before entering. The key idea is not to trade blindly. Use structure and confirmation. The biggest beginner mistake is treating the bands like automatic signals. Price touches the top band and traders instantly sell. Price touches the bottom band and traders instantly buy. But markets do not work that simply. In strong uptrends, price can continue touching the upper band. In strong downtrends, price can remain near the lower band. Instead of fighting the move, identify the environment. Trending markets behave differently from ranging markets. Context changes everything. Here is a simple beginner approach. Wait for the bands to tighten. Be patient during the quiet phase. Then wait for a strong breakout candle. Look for momentum confirmation such as volume or RSI strength. Enter in the direction of the breakout. Place your stop below recent structure. Target the next clear resistance or support level. This approach uses patience first. Then it trades expansion. Hi, I'm Indy. So let's summarize. Bollinger Bands are not magic. They do not predict the future. They measure volatility. They show when price is stretched. They show when the market is quiet. If you understand when to expect expansion, and when price may pull back, you turn a simple indicator into a powerful tool. Smart trading starts with understanding, not guessing. If this helped clarify things for you, make sure you subscribe and explore the rest of the Indicator Library. We're building real understanding here, step by step, and I'll see you in the next one.